I have a trading checklist that I go through every single trade that I make that helps me become more profitable. I'm going to share it with you right here. So if you come over to my screen, we have Google up here on a daily chart. And I'm going to use Google because it is kind of getting to that point where I may actually execute a trade here. It won't be today, and you'll see why, but it's the opportunity is imminent. So the first thing that I always look for, first and foremost, you have to look at trend. The trend is everything when it comes to trading, and that is what all of these squiggly lines are down here. So if I go through 100 stocks, I'm not even looking up here. I don't look at this at all. I really just start by looking down here. Am I close to the sweet spot? Am I moving into the sweet spot? And if we zoom in a little bit, you can see that our red line right there and our yellow line up top are moving towards this sweet spot. What is in the sweet spot? This is the area that gives you the highest probability to make money. So when you're coming down, you want to be coming in from the top, dropping below 80%. If you're going long on something, for example, back in here, you want to be breaking through this 32% line, that's the horizontal line, getting into that area that's going to give you the highest chance to make money. That is really everything that starts a trade. So for Google right now, it is basically imminent that this thing is going to drop down into the sweet spot and I'll have some type of shorting opportunity. Now, the trend is there. What's next? To me, it's volume. Volume is something that you need to pay a significant amount of attention for. And for me, I like to see, this yellow line right here is the average volume. I like to see 30% of the average volume in the first hour of the trading day. So if you come right over here, you're probably saying, well, how do you know what the average volume is? We'll come right over here on your chart. You can go on your iPhone, go in the stocks thing. It'll tell you AVG volume, and then it'll give you volume. You can compare the two of average volume versus volume in that day. 23.6 million shares traded per day. Right now, we're sitting about 4.13. It's after 10:30 in the morning. So right now, we're sitting 15 to 17% of average volume. That's not going to cut it for me. Why is that important? Why is volume important? It drives everything in the stock market. If we want a stock that is going to drive itself down, we need to have a lot of sellers on our side, like yesterday. But yesterday you had a lot of buyers and sellers. That's why you had the wicks on both sides. So for me, I need to see a lot of selling. I'm going to draw it in pink. Let's say a lot of selling volume here for probably multiple days in a row. And you notice where I'm drawing these bars. I'm drawing them above the average volume line, meaning that you need to have sellers on your side. So if you're going short, think about it this way. We're going to go long in this position. We're pushing a boulder up a hill, right? Is it easier for you to just push it up by yourself or to have 10 people push that boulder up the hill? Well, of course, it's easier to have those 10 people. You want people on your side. So in this instance, you want, let's call it 10 people. In really this case, you would want about 9 million people pushing this 23.625 million pound boulder up this hill. That's the idea behind this. So if you're not getting that volume in there, that's something that you can't trade. Now, that could change. It's only 10:42 in the morning. The afternoon can go crazy. That's why you need to pay attention to these things. Now, the next thing that we look for is the engulfing candlestick. The engulfing candlestick will come from the volume. So if you got all that selling volume that I was just talking about, let's say that the volume shoots up today and we end up closing the day up here with volume. Well, what's going to happen? This candle is probably going to fill out to look like that. You're probably going to get some type of big move. Why? Because everybody's going in the same direction. Everybody's rowing and pushing in the same direction. So we don't have that engulfing candlestick right now. But that doesn't mean anything. I still need trend to be in the sweet spot. I need volume to increase. Then I will get that engulfing candlestick. I'm hoping that happens tomorrow or Friday. I'm really hoping that it happens tomorrow so I can start a trade on it before the weekend begins. Now, the next big part that I look for is called the bid-ask spread. And you're probably asking, what is that? I've never heard of that. Or if I have heard of it, I don't really understand what it means. This is where I hear the majority of people say, Mo, every time I buy a stock, the stock price goes against me. Why does that happen? Well, there's a little something up here in the upper left-hand corner of my screen called the bid-ask spread. The blue, this is the ask price. Remember, this is a market. You have somebody buying something and somebody selling something. So this is the market maker right here. They want to charge you right now $165.48. Now, what somebody's willing to pay right now is $165.40. Well, now it's 43 cents, but you can see it moves around every single second. 44 cents, 43 cents. What's the consensus? 1 or 2 cents. That means that there's an agreement between the two parties that we are going to buy this thing and there's a 1 cent difference. The market maker is going to make his little spread. You're going to be happy. Now, the difference becomes when this spread number in the middle gets to 30 cents, 40 cents, 50 cents, $1 in some cases. You're typically going to see this in the beginning of the day or if there's a ton of volatility in a stock. You're going to go in there, and those of you that are options traders, you probably understand this. You're going to go in there and say, all right, I want to buy this thing for $165, and we're going to call it 40 cents because that's the last number that I saw. Now, this is the bid. This is what you want to pay. What is the ask going to be? Well, if there's a lot of manipulation going on, it can be 165.70. All right, well, this is the ask. Okay. Now, if this person goes in and buys this. Yep. Now, if this person goes in and buys this at a market order, remember we're talking market orders right now, you think that you're going to go buy it for $165.40. Well, you're going to put it in as a market order. You're actually going to get it for $165.70. So you paid 30 cents more than you wanted to pay. You don't like that. But you didn't check that there was that 30-cent spread between the two. There's some manipulation going on in the stock. Maybe there's overnight trades that are settling, etc. Now, what's going to happen? Well, you're going to get it at 70, but he noticed, the market maker noticed, well, the majority of the bids were at 165.40. So what's going to happen? He's immediately going to drop this ask price to call it 165.50. And what does that do to you? Well, you immediately lost 20 cents a share, and you're saying, well, why did I lose right off the bat? Every time I buy something, it happens. And if you're buying volatile stocks, this has probably happened to you a lot, and you probably didn't know why. This is why. You need to make sure that consensus between the bid and the ask price is, I would say, 1 to 5 cents. Now, if you're getting into something that is more of a, I don't know, a $500, $600 stock, yes, it's okay to have a 20-cent spread, a 30-cent spread, but it's all relative to the stock price. I would say if you really confidently want to buy something and say that the price is not going to move much on me, stick to that 1 to 5 cent range. But bid-ask spread is incredibly important. Now that easily leads into when do you buy a stock? What time? And trust me, time does matter. If you notice in the previous number of bid-ask spread that I said you need to be buying stocks when overnight trades have settled down. That's a big thing. So because overnight trading needs to settle down, everything settles in the first 30 minutes of the market. I don't trade until 10:06 in the morning. So the market opens at 9:30 Eastern time, right on the nose, 9:30. I wait and wait and wait and wait until 10:06 in the morning. By 10:06, I've found that most of the volatility is over. You're going to see, I want you to pay attention to this next time you're looking. Go and just look at bid-ask spreads for the first 36 minutes of the market. First 36 minutes, you're going to see massive, massive bid-ask spreads on especially stocks that are volatile. But about 10:06, everything kind of simmers down. Consensus is there. People are agreeing. Unless there's not big news on a stock, you're pretty much going to get that 1 to 2 cent bid-ask spread. So timing of the market is very, very important. Do not trade stocks, especially if you're new, until after 10:06 in the morning. Now, something else that you see on my chart. You see all these squiggly lines over here, and a lot of you know that these are moving averages. This is the 100-day moving average. This is the 50-day moving average. The purple line is the 25-day moving average, and the white line is the 200-day moving average. These play a role in support and resistance. What do I mean by resistance and support? Well, if you look at Google back here, let's just use this as an example. Well, the stock price went up, it fell down, and you notice it kind of just hugged the top of this purple line. Couldn't get over it. That's a resistance point. So moving averages play a role in resistance. Think of a steel I-beam, it just can't break through it. Now, when you're coming down, look at this. This thing came down, and what did it do? It got sucked right back up to those moving averages. It broke free of all of them, but it got sucked right up. These things play a role as like a magnet. That is the importance of moving averages, knowing that they're going to play a role of being steel I-beams that you can't really get through, and magnets, they just want to keep pulling you back to them in both directions. Now, it's not only moving averages that you need to pay attention to. This is where zooming the chart out and really, really helps a trader. Now, if we look at this, again, Google back here, this is 2021, 2022. And if we just draw this line across, what do we notice here? Yeah, you dip down below it and you get sucked right back to that same level. And then you went above it for a short amount of time and you get sucked back down to that same level. So right in here, this is a really, really strong resistance point. We want to make sure that, look at this. For example, right now the stock price is about here. We're running into the 100-day moving average. To me, the 100-day moving average is going to play a steel-eye beam. It's not going to be able to get through it. And where is it going to throw the stock price down to? Probably right back down to here, because there was a lot of resistance that happened in 24. There was a lot of resistance that happened here, or support that happened here at the end of 23. And then, of course, all through 21, or the latter half of 21 and the beginning of 22, you still couldn't get through that level. So knowing where your support and resistance levels are is very important. So if we just zoom in even closer now and draw some lines, there and there. This is kind of be your consolidation area. Will you pop above it? Yes. Will you go a little bit below it? Yes. But you're going to stay in this range of about $167 to about $162. It's very important to understand where your consolidation channel is, where support and resistance are going to take you. Now, looking at another important checklist item, it's patterns. Everything in trading is about patterns. Ugly face patterns, head and shoulders patterns, tweezer patterns, 50% rules. All of these things are very, very important. So if we look here, and I'm looking at Google still, if I just I'm going to draw an eye right there, and I'm going to draw another eye right in here, and I'm going to draw a mouth. That is an ugly face pattern. I'll draw a nose in there. This is an ugly face pattern. And what typically happens to ugly face patterns? I'll give you a second to answer. They typically go like this. So a lot of things are pointing to my side that Google is going to go short. That's why I chose this one. It was running into the 100-day moving average. It has this downward trend, and more importantly, it has this ugly face pattern. What happens to ugly face patterns? It's a very bearish signal, and they tend to drop off. So in this case, I'm looking at Google for the ugly face pattern. Now, I could also look at where were some head and shoulders patterns back here. And let's see, a head here, a shoulder, and this is your body. And what typically happens with head and shoulders patterns? Well, they do this. It's another bearish signal. You can go through, I actually implore you to go through and look at a chart and try to find these head and shoulders patterns, ugly face patterns, and say, okay, where is the stock price going to go? You need to be able to recognize these things if you want to be a profitable trader. Another one is a 50% rule pattern. So if I'm going to pull up CCL here. CCL is a great example of this. You have a high right here. Oops. You have a high right here, 52-week high. Well, actually more than 52-week high. You have a low right here, and then you have this middle ground right here in the middle. And you notice this stock price ran up to it and fell back down, and ran up to it and fell back down, and up again. And look at this. It cannot break through that level of basically $18 a share. Why? Because everybody that lost money back in here in 2020, all they wanted to do, and this was the previous, let me draw it in blue. This is the previous 50% rule right here, same level. You notice that they wanted to get back half their money. So they just said, okay, I lost money here at 56. If I can just get half my money back, I'll sell. And what did they do? They sold. They sold in here, it fell back down. These same people that missed out, they say, okay, I'll just sell next time. And every time it hits that level, it just keeps falling back down. And now we have a new 50% rule. That's this area down here that I drew previously. So you need to be able to identify these different patterns. How do you do that? Zoom the chart back. Now you might be looking at this and saying, wow, this is so much information. This is like it's like putting a garden hose in my mouth, but it's actually a fire hose and just like flushing me with information. It's really not that bad. There are so many people in my Patreon community that go through this. We have a trading series of videos that goes through all of this, and you will get this checklist when you join the community. You'll get all of those bullet points that I just talked about, and you'll learn how to use them. You'll understand how to use them. You'll also be able to talk to other people in the community that have already been through this. They know what they're doing. Ask them questions. There really, really are no dumb questions. Listen, everybody started out as a beginner. I started out as a beginner. 21 plus years ago at this point, I started out as a beginner. I had a mentor. I asked him questions. I still talk to him to this day. I still ask him questions here and there. This is what this is all about. It's by being in a community, having other people to talk to, having the right checklists to go off of, having the trade setup to go off of, having the trading series to go off of, so I can do the legwork for you. You just have to be the one to learn it. So right now, it's $25. There are very limited spots available. The link is in the description below. please check it out. Join us on the next live streams. I made a video on different chart patterns, and it kind of goes to what we were talking about today. Click this video right here. Go watch it.